Good day everyone. Today my team and I will be presenting on the topic ethical concern and mitigation strategies in financial risk, which is part of our international financial management course. We are a group of students from DPI 5. Three ethical concern. There are three main ethical concerns that are closely related to financial risk. These are scams, bribery, and money laundering. Each of these issues can cause significant harm to financial institutions, their customers, and the overall economy. We will now look at each one in more detail, starting with scams. Scams involve fraudulent tactics used to trick people into giving up money or sensitive information. A common example is when someone receives a fake call pretending to be from a bank asking for a credit card details. From an ethical perspective, financial institutions have a responsibility to protect their customers. They must ensure secure communication and educate the public to raise awareness about fraud.
Bribery. Bribery includes offering, giving, receiving, or soliciting something of value, such as money, gifts, or favors, in exchange for influencing the actions of individual in a position of power. These actions are often unethical or illegal. Types of bribery. The first one is active bribery. When a person offers, gives, or promises a bribe to influence a decision. Example, a company executive offers a government official a luxury vacation in exchange for awarding a public contract to the executive firms. For the second one is passive bribery. When a person accepts or requests a bribe in return for a favorable decision or action. Example, a customs officer asks for extra payment to allow unauthorized goods through inspection. In ethical concerns, bribery undermines trust and fairness in both public and private sectors. It leads to biased decision, misallocation of resources, and loss of public confidence in institutions. Honest businesses suffer when competitors win deals through bribes rather than merit. Real world examples. FIFA corruption case in 2015. Senior officials of the football governing body were charged with accepting bribes in return for awarding broadcasting and hosting rights. Money laundering is the process of disguising the origins of money obtained through illegal activities such as drug trafficking, fraud, or corruption, so that it appears to be legitimate income. Typical crimes linked to money laundering: drug smuggling. Criminal launder proceeds from narcotics sales through shell companies or offshore accounts. The fraud schemes: money obtained through scams, Ponzi schemes, or cybercrime is cleaned to enter the financial system unnoticed. Insider trading. Profits earned from illegally using confidential information are often laundered to avoid regulatory scrutiny. Stages of money laundering. The first one is the placement. Illicit money is introduced into the financial system through cash deposits. For the second one is layering. A series of transactions such as wire transfer, currency exchanges, or shell companies obscures the money's origin. The third one is the integration. The money is reintroduced into the economy as apparently legitimate assets such as real estate, business investments, or luxury goods. Ethical concerns. Financial institutions play a critical role in detecting and preventing money laundering. If they fail to monitor suspicious transactions, they become complicit in criminal activity, threatening economy integrity and public trust. Real world examples: HSBC scandal 2012. HSBC was fined 1.9 billion for failing to prevent money laundering by drug cartels in Mexico.
So there are 4 strategies for mitigating this risk. First one is avoidance, second one is transfer, third one is acceptance, and last one is limitation. So one of the most effective ways to manage financial and ethical risk is through avoidance. This means staying away from activities or decisions that have a high probability of causing damages. In the financial sector, this can include avoiding partnerships with clients or businesses that fail to meet compliance standards. For example, banks can use strict know your customer procedures to avoid onboarding individuals involved in suspicious activities. Avoidance also involves preemptive actions like testing a financial product for security flaws before launching it to reduce the breaches or scams or data breaches. The goal is to remove the threats before it ever becomes a problem. So ethically, avoidance helps protect the customer trust and ensures that institutions are not enabling bribery, fraud or money laundering by neglecting proper due diligence. The second strategy is risk transfer. This means moving the risk to another party, typically through insurance, partnerships, or outsourcing. For example, financial institutions often purchase cybersecurity insurance to cover potential losses from online fraud or scams. This way, if a cyber attack occurs, the financial impact can be handled by the insurance provider. Another common approach is outsourcing fraud detection to expert cybersecurity firms. These firms are better equipped with the tools and expertise to detect threats like phishing, scams, or attempts to launder money. Transferring risk does not mean ignoring it. It means that you are acknowledging your limitation and working with the specialized partners to protect your operations and customer ethically and effectively. My name is Fandi Pratama Putra bin Senal Mutakin. My meeting number is 08DPI 22F2068. I want to continue about strategies for mitigation this risk, which is the third. This is acceptance. For acceptance, when the cost of eliminating a risk is too high, the institution may choose to accept it. Example, tolerating minor losses due to fraud but monitoring them closely. So must be done with transparency and careful monitoring to remain ethical responsible. Other than that, example, if a bank experiences small, infrequent cases of fraud that causes minor financial loss, the cost of fully preventing such fraud, like advanced system or complex security layers, may outweigh the loss itself. So the bank accept the risk but keep it. I'm going to explain about limitation. Limitation is partly a step like setting transaction limit and using fraud detection tools help reduce the likelihood and impact of risk without stopping operation entirely. This need to educating staff to spot suspicious activities, strengthen internal defense and prevent issues from escalating. These measures allow the business to continue operating securely while protecting customer and upholding ethical standards. For example, setting a daily transaction limit of $5,000 per customer to reduce potential loss from fraudulent activities. This doesn't stop all fraud, but it limits the financial damage if it occurs.